All right, let's check if the live is on. Are we live? Okay. Okay. I think we are live. Okay. Right. So good to know that we're live. Yeah. Okay. Hey everyone. So I'm back. I hope all your exams are going great. So what are we gonna cover today? I know it is a late night stream, but the idea behind the stream is, I'm gonna cover almost all formulas, show you a couple of examples, and I've planned out, something for standard costing. We will try to look at one master problem that I've created, which is going to cover all sorts of variances, including the reconciliation part. All right. So this is what I've planned for. So without wasting any further time, let us get into it. One other thing, in the description, there is a link for a Google form. You guys can access it. Once you submit it at the submission page, you will be able to, access all the notes that I'm gonna show in this session, right? Along with it, I did prepare, two master problems PDFs, which, cover a lot of major adjustments that you need for the exam. I don't think there are gonna be any mathematical errors, but you guys can get through it. All right. So this is regarding what I'm gonna cover. I'll try to see if I can cover these problems as well, as it's already a late night stream. Let's begin. Okay, so what are we going to look at? First, let us start with elements of cost. Module 1 is already done. We do have videos uploaded. If you guys want, go check it out. Right, there is a playlist created for this. This video is also going to be saved. It is not necessary that the live has to, vanish once it is done. Okay, let's begin. So, model 2, when we talk about elements of cost, majorly we look at materials, labor, and overheads, right? This is one major chapter which is pretty scoring. If you are thorough with your formulas, you are good to go for the sums. So that is how this entire chapter is, structured. In this 17 pages, we'll be covering almost all the modules except for module 1. So let's get into it. First and foremost, material cost. What is EOQ? Economic order quantity. For any running business, they can't have 10 orders or 100 orders at a irregular interval, right? Because for every time, okay, let us just assume you guys order food from online platforms, right? Or groceries. Let us say you uh, use Zepto. When you use Zepto or Blinkit, any platform that you see, they usually have handling charges or delivery charges or order charges. These, for instance, every single day you place around 2 orders and you continue to do that for 15 days, right? For these 30 orders, you are paying approximately 10 rupees every single day. Yes or no? Rather, what you can plan to do is instead of having 2 orders for 15 days, you can plan to have around 7 orders, maybe around 5 days, right? What are we trying to do? We are trying to club the orders that we're gonna need based on their perishability, their requirements at home, right? Similarly, when you start doing this, this is basically what we talk about in an entity known as EOQ, economic order quantity. To reduce the carrying cost, see, at home you will not have any carrying cost because max to max you save all your groceries and your homemade containers or anything that you have, right? You just preserve them. You don't have any carrying cost. What is carrying cost? For instance, you rented a godown, being an entity, you pay rent for it. And if you have large volume of stock ordered at once, and you have to sustain that stock in the godown, it is a carrying cost, right? So ideally you would want the carrying cost per unit as low as possible, at the same time ordering cost per order as low as possible. For that, we have a formula, that is root over 2AO by C. That is 2 into annual demand into ordering cost per order divided by carrying cost per unit. Right. Once this is done, you have to understand, whenever you figure out EOQ in the question, right? Since we have a stepwise marking, what you guys can do is you can just write down verification of EOQ and use the EOQ figure to match with the total order cost or total carrying cost. You just multiply it per order or per unit, and you will be able to get it. It should match. Then you will know that you have not made any error. This is just a verification point of view that you guys can do it by yourselves. Next, reorder level. Reorder level, remember, for any entity which is dependent on movement of goods, or you get your raw materials from a very long distance, what usually happens is, from Delhi to Hyderabad, you need to get something. So maybe it ideally should take 2 to 3 days. What if we know that the maximum lead time is going to be around 7 days, and the maximum usage during that period is going to be around 500 units? When the maximum usage and the maximum lead time are multiplied, that means we get 7 into 500, 3500 to be our reorder level. Whenever we are hitting this, it is always, advised for any entity to reorder its stock, because by the time this 7 days, passes, and 500 being my daily consumption, max to max, it is going to take 7 days, and daily I might need 500. So this 3500 is gonna sustain my business until I get my next order. That is the reason why reorder level is at maximum usage into maximum lead time. I'm trying to explain the concepts so that even if you don't remember what the formula is during the exam, you can easily figure out based on what figure should you pick up from the question and solve them, right? Next, minimum level, maximum reorder level into average consumption and average lead time. Simple. Okay, maximum level. You can multiply. You can, okay. You might have to find them vice versa. That is something you might have to do. So I'm not gonna explain that. Okay, maximum usage. If they ask, I don't have to tell reorder level divided by maximum lead time, right? You guys can figure that out. Okay, maximum level. There is another formula to understand what the maximum level is. ROL plus EOQ minus minimum usage into minimum lead time. So what is he trying to say? EOQ is the economic order quantity, which is like the quantity you should be trying to order your goods so that you can keep all your costs to the minimum, right? So what is reorder level? It is the level at which I am gonna sustain my business even if there is a maximum usage and a maximum lead time for me to get goods. So we add both of this, and while we add both of this, we already get a decent amount of quantity. But when we get this, we should also understand, was it what if we have so much inventory right now and the usage is very minimal? Exactly the point. When the usage is minimal and you have this entire quantity packed up, that is when you find your maximum level by ROL plus EOQ minus minimum usage into minimum lead time. Average level, maximum plus minimum divided by 2, or minimum into half EOQ, right? This is similar to average inventory formula, right? Opening plus closing by 2 or closing into 1 by 2 of the value. Sir, what is EBQ? EBQ is similar to EOQ. It is just economic batch quantity root over 2ds by C into root over P divided by P minus D. Sir, what is D? Sir, what is P? What is S? D is the annual demand of the good. S is the setup cost. C, we are already aware, it is still the same carrying cost. And P is the production rate per year. You just have to substitute these and you'll be getting your answer. Ideally, we don't see this asked often. EOQ is something the institute prefers to ask quite a lot. Right. Majorly, we also get, questions based on find out value of inventory or the closing stock value using FIFO and using weighted average. Actually, let me take you guys to this sum and we can cover it right now. Right. No, this is supplementary. Right. Okay, there we go. Sir, what is the question you're talking about? Stores ledger is asked to prepare under FIFO and weighted average. Side by side, you just have to show the comparison, okay? So ideally, sir, value of inventory is never going to change for FIFO and weighted average. The only thing that changes is under one, either the issue value is going to increase or the other, the closing inventory value is going to increase. But overall, the value is going to still be the same. Let us look at one of these sums. Okay, so what is given? Stores department during April is given of receipts and issues. Opening balance, units, rate, and value. Great. We received GRN goods receipt note. Okay. Issued to production, received, issued, received, and issued. Okay. So what is the question asking? Prepare the stores ledger account under FIFO, first and first out, showing each value at each issue and the closing balance. Similarly, prepare stores ledger account under the weighted average method, recalculate the weighted average after each receipt. Okay. Compare the total cost of material issued and closing stock value under both methods. Right. So FIFO, very simple. First in, first out. For example, I am buying at different prices 100, 110, 120, 115. And every single time, for example, I'm only gonna purchase 100 as my quantity. Okay. So what should we do? Sorry. Right. So what should we do under FIFO? For example, there is an issue of 250 units. Sir, I've purchased at different prices and these are the units. So when the rate is different, can't I simply take an average? When we take a weighted average, that is where we look at the weighted average valuation. But for FIFO, for 250, I'll have to split it. How, sir? First batch is of 100 units. Great. 100 units. At what price? At the rate of rupees 100. Second batch 100. We have 250. We only completed 200 demand. So the second batch is at 110. So rupees 110. Third batch, we need 200, sorry, 250. We already finished 200. That means we still need 50, right? So this 50 is going to be coming from the third batch at the rate of 120. So this is the issue, right? So what is left, sir? 50 out of the third batch at the rate of 120 and 100 quantity at the rate of 115 is left. So this is going to be the inventory value or the closing stock value. This is how FIFO works. So in this sum, let us look at it. April 1st, 200 units received at 15. Balance 3000. April 7th, we again, okay, this is the opening stock. April 7th is a receipt of 300 at the rate of 20. Okay, 3000 plus 6000. Sir, on April 10th, we had an issue. How much is the issue? Issue is of 400 units. We already have total of 500 units in stock. That means 500. Are we going to use all 500 here? No. He only needs 400. So first we have 200. So we're going to use 200 at the rate of 15. Then in the balance 300, we're going to use the other 200. That comes to the issue of 7,000. So what is the left, sir, as value? In this 300, we only have 100 units left at the rate of 20. So 100 into 20, 2000 is the closing balance. This is under FIFO, right? Similarly, we get stock. We add entire stock. Okay, so once we get the stock, I think there is an issue of 150. There was an issue of 150. So receipt, sir, this 100 has to be first utilized, and balance 50 should be coming from April 15th stock, right? Great. Again, we repeat the process and we are done. So total issues value will be coming from the issue value column and the balance. So at the end, there was 200 units issue. Here we already had 150 units from April 15th stock. 200 units, 150 is done. From 150, we used 50 done. That means 100 units is going to be left out of April 25th stock. 100 into 26, it's going to be 2600. So what is the weighted average method? Very simple. You just have to calculate the weighted average and you can just use it for issue. First, understand, ideally you wouldn't multiply these figures and then divide by 4, and that is not the weighted average you're going to get. Weighted average here is recalculated after each receipt. He has specifically mentioned after each receipt you have to recalculate it. That means with every receipt that we get, our valuation of the stock is changing because we have to take a weighted average. So 200 into 15, 300 into 20, that is 3000 plus 6000 divided by 500 stock. So the weighted average value of the stock of total 500 units is going to be 18. That is how we value it. So we have issued 400 required. Superb, great. So 100 is left. 200 is again received. So 200 into 24 plus 1800, 4800 plus 1800 divided by 300. Sir, how did we get 300? Previous balance of the stock we have is 100 and the receipt we got is 200. Total 300. The same steps are repeated and in the end we get a total value of issues and the closing values. Sir, observe something. Total issues under FIFO is 15,100. Total issue under weighted average is 15,300. So we have a difference of 200. Closing stock here is 2,600. Closing stock at the bottom is 2,400. We again have a balance difference of 200. This 200 difference is what we see. But in the end, total of the stock must be 17,700, right? If you compare both, VAM has issued more, 200 rupees more. Why? 15,300 has been issued to the production department. But closing stock has reduced by 200. Similarly, under FIFO, issue is less, but the closing stock valuation is more by 200, is higher. Got it? All right. So let's get back here. So we are done with FIFO. Similar for the last value of receipt is when you use for utilization. Ideally, Indies doesn't allow it. Okay, labor cost. Sir, I'll say plan. These are for wages, right? I'll say row 1. Time taken into rate, it is pretty common. So what do I have to remember? 50% into time saved into rate would be, I'll say, and for row 1, time saved by time allowed into time taken by time rate. Okay, time saved by time allowed. I have saved around 5 hours, but the total hours allowed is 10 into time taken. Actually, I've saved 5, but I've used another 5 into rate, that is maybe 30. The initial part is going to be the same. Here you plus, here you minus. So why are we doing it? I'll say total time taken, we are adding 50% of time saved into rate, stating that, okay, you have saved this. So how about I add this as an incentive? Rowan says, you have taken total time. Great. Now, I think this is also plus. Yes, my bad. Now, Rowan says, it is not just that. I'm going to take a proportion. I'm going to take a proportion of the time saved out of time allowed as a proportion and give it for time taken into time rate. I'm gonna take the initial and pay you on the base itself. I'm not gonna pay you only for the time saved into rate. That is the difference between Halsey and Rowan. So labor turnover, number of segregations divided by average number of work, idle time, idle hours into rate, that is charged to overheads, and P&L, not production cost, right? Why? Whenever an employee or a laborer is not working in the plant, those hours are not giving you any output towards any specific unit production. When it is not directly related, do you consider it for the product cost? No. You consider it as an overhead and charge it to P&L. Overtime premium. Actual rate minus normal rate into overtime hours. Simple, right? Actual rate is X, normal rate is Y. The number of hours you worked is gonna be the overtime premium paid. So this we have covered in chapter 1, overhead absorption rate. Always take budgeted, if not standard. Under or over absorption comes when absorbed overhead is less than actual. So absorbed is only 120, but actual is around 140. That means out of this difference, 20 of overhead I have not absorbed. That means I've under absorbed. The vice versa. If actual is around 120, but absorbed is around 160. So the difference here is 40. That means I've absorbed more. I have, rather than the actual, I have absorbed more. That means it is over absorbed. Supplementary rate, under or over absorption divided by actual output or actual number of hours. Okay, we have a very basic sum. You can read through this, put in the figures, get the values. Again, Halsey versus Rowan comparison, they're gonna ask. You just put in the inputs and you get it. Rowan always gives you higher wage. Why, sir? On the base you're paying, sir, not on the amount saved. How is amount saved? Time saved into rate. This is the amount saved, correct? Time saved into the rate is kind of the amount saved. You're not paying out of it, you're paying on the base. Base is always going to be more because part of the base is obviously going to be, the total base is obviously going to be time saved, correct? You can't expect more than 60% time saved and 40% time taken in any process, ideally. Okay. So a very scoring part, like module 4 is like a beautiful chapter. Pretty easy. You just have to do a lot of reconciliations if they ask for it. It is going to be pretty easy. It is similar to BRS for anyone who struggles with BRS. You don't have to worry. You're not gonna struggle with costing and financial profit analysis over here. Sir, integrated and non-integrated. So understand, books are maintained in two separate sets. Okay. Why? Production team, costing team, they're gonna prepare their cost books. And CAs or the finance team, they prepare their financial reports. They don't include the ones which the other party does, right? For example, do you think the production team or the costing team are gonna include interest on capital? It is nowhere related to costing. They will not, have it, right? Similarly, there are gonna be aspects which the finance team is not gonna include. A lot of times, whenever there are non-integrated, you know, books, that is when we'll have to do a reconciliation. When they're all maintained under one set, profit in the end is always going to be the same, sir. So you have to understand the reasons and then evaluate their impact on costing profit or financial profit. Let us look at this. Let us ignore this part. You don't have, okay, adjustments is what we're going to look at, right? Okay, in purely financial income, interest or dividend received, do you think costing people are going to be aware that, I've received so and so, so let me adjust it in my revenues so that my profit is going to increase? No, right? So when this is increased, costing profit is always going to be less. Let us actually take figures over here and, build this up. So let us take 100 rupees as the costing profit. Okay. I've received 5 rupees as dividend. Okay. This 5 rupees ideally is going to be in financial books and not costing books. That means this costing profit is going to be less than financial books. Yes, costing profit is going to be less than financial books. That's the reason why when we have to do the same, we are going to add it to costing books. If we are deriving from financial books, we're going to subtract it. Why? Costing books is already lower, financial profit is already higher. If you start from costing to go up, you will have to add. Similarly, if you have to come down from financial, you have to subtract because you're starting from financial, you're going to reduce. If you're starting from costing, you're going to increase. Purely financial expenses: goodwill written off, donations, preliminary expenses, right? Incorporation expenses. These are only going to be in financial books, not in costing books. So obviously, when these are expenses, that means we have already reduced the financial profit, correct? Would you have reduced from costing profit? No, right? That means if you start from costing, you're going to reduce. From financial profit, if you are already reduced to meet the costing profit, you're going to add. Simple, right? Notional charges in costing book: notional rent, notional interest. Ideally, we don't have any notional, entries in financial books here. That means these are charges. You already reduced your costing book profit. So you add to costing. If not, you subtract for financial books to meet the same. Overhead absorption or over absorption of overheads. Sir, actual is only 120. I have absorbed 160. That means I have overbooked an expense in my costing books. Correct? When I've overbooked, so let us say I have 100, I have 100. Actual is what the financial books are going to take, correct? But in costing books, I have over absorbed. That means my costing profit, effects on costing profit is always going to be lower than financial books, correct? That means if I have to go from costing books, I should add the difference. If I should come from financial books to costing, I should reduce the difference, right? Excess cost charged in cost books. That means I'm going to add to costing books. I'm going to subtract to financial books. The opposite is going to be the under absorption case. Let us assume 120, actually, financial books, costing books. So in costing, I have under absorbed, but the actual is 160. Then what do? I'm going to do the opposite. Costing is going to show higher because less is charged in costing. That means for costing, I'm going to reduce from costing books, add to financial books. Opening stock overvalued in cost books versus financial books. So similar, sir. Opening stock is overvalued, right? That means my profit is going to be less. If my profit is going to be less than financial books, what should I do? I should add to meet to costing books. I'm going to add. If I'm starting from financial books, I'm going to subtract. The opposite is for the closing stock. For closing stock, I have overvalued. That means in my cost books, my profit is going to be higher. That means from costing books, I should reduce. If I'm starting from financial books, I'm going to add, right? So reconciliation format is a very standard thing that they're going to ask in the exam. So if you start from cost accounts, I mean, you can add items increasing costing profit over financial profit under absorption. Financial expense. See, you don't have to by heart this like this. If you understand the logic, like I've mentioned, or if you don't even remember the logic, write down figures 100. One is the actual, the other is, under absorbed. You're going to obviously see the difference in profits. And you know from which profit are you going to start. When you know the profit and you know the difference, you have to do the opposite, right? That's what you're going to do. Okay, one reconciliation statement is given. Profit as per cost books. Financial profit, P&L shows dividend received. Sir, let us solve this. Solution is given here. Now I'm going to put it here. I'm going to write. Okay, sir, costing book I've started 1,42,000. Financial shows a dividend received. Received means income. That means financial profit has already increased. Now I should increase my costing plus 18,000. Interest on loan. Interest on loan. Loan is a liability. That means interest is going to be a outflow. Outflow is an expense. That means I've reduced in the financial books. That means I'm going to increase. Sorry, I've already reduced over there from costing book. If I have to match the financial profit, I'm going to reduce in the costing profit. Goodwill written off. Goodwill write off. If you notice here, what we did discuss. Pure financial expenses when goodwill is written off, it is an expense that only affects the financial books. Similar to the interest on loan, we should subtract 8,000. Notional rent charges in books. Sir, costing books I've reduced notional rent. Financial books, I don't think they would have done it. That means costing books profit has reduced because of the notional rent, which I have to rectify. So I'm gonna add 15,000, right? Opening stock valued 6,000 higher in cost books. We just discussed opening stock is overvalued in cost books. That means effects on costing book are going to be lower because opening stock there is going to be higher. So costing book profit is going to be lower than financial book profit. So what do we have to do, sir? We have to subtract. I'm sorry, what? Sorry, we have to add 6,000. Overvalued. Higher means overvalued in cost books. So since we have overvalued it, we have to, it is not the same. Yes. I'm confused for a bit. Closing stock valued 4,000 higher in cost books. Again, subtract 4,000. Overhead absorbed in cost books. Overheads over absorbed. So over absorbed. We just discussed with an example. If the overhead is over absorbed, that means costing books are gonna show less profit than the actual. Just a second. Ah, that's better. All right, there we go. So what are we talking about? Closing stock is, sorry, I'm not talking at closing stock. Overhead is over-absorbed in costing books. That means we have overbooked an expense. Overbooked an expense means costing book profit is already reduced. So financial book profit is already higher. So we have to match from costing to financial. So we're gonna add 9,000. Overhead over absorbed in costing books. Okay. I'm not sure if on somewhere wrong. Cost books. Items reducing profit. Interest on non-financial expense not in cost book. Are the signs all wrong? The signs are all wrong. We calculate 142. The solution here given is wrong. All the form, I mean, the signs are wrong. Items reducing costing profit was it funny? Dividend is not, so we should add it. Anyways, let's move forward. So methods of costing. How long has it been? 40 minutes. Okay, we have two viewers. Okay, so methods of costing is one key area where they press a lot on process costing, contract costing, batch costing, or job costing, right? Let's look at the formulas. Costing per unit of normal production, I mean of production. Total cost minus scrap value of normal loss divided by expected output. As simple as it is. Total cost, for example, is gonna be like 1 lakh. But I notice there is a normal loss. But the normal loss could be resold. That means it is an income against a cost. So I have to reduce it 5,000. And the expected output by giving a number of input, let us say 500, that would give us the cost per unit for normal output of production. Because in normal senses, value, I mean, having a normal loss is fine. And to mitigate the sale value against or of a normal loss, we reduce it divided by number of units, get it cost per unit. Expected output is input minus normal loss. Like I mentioned, whenever we're calculating normal output, we also include normal loss into consideration. So input minus normal loss. So once I've included normal loss into consideration for expected output, any excess of loss or actual being less than expected output is always going to be an abnormal loss. After, for example, I've put in 100 units of material and I expected, okay, let us say 1,000 and 100. This is what I've expected. Actually, with this expectation is supposed to be 105, for instance. But since I expect 5 of normal loss, the expected output is at 100. Sir, that means whenever I'm putting in 1,000 units, despite losing normal loss of 5 units, I am going to consider my expected output to be 100. Yes. But I inputted 1,000, but my actual is only 95. That means, don't you see the difference of extra 5 units from the expected output? This 5 is known as abnormal loss, expected output minus normal loss. When actual is less than expected, you're losing more, right? Similarly, I've put in 1,000. I got 105. Sir, expected usually normal loss is 5, but I got beyond 5. I mean, beyond 100, I got 5 more. That means it is an abnormal gain. Ideally, it shouldn't happen. So value of abnormal loss or abnormal gain is units into cost per unit of NOP, normal output of production. Equivalent units, units complete plus closing stock into percentage of completion. Sir, what is this equivalent unit, sir? For instance, I started a process, okay? I started processing 1,000 units. Out of 1,000, I've already exhausted 750 and I got X as a finished good. Sir, but for the 250, what happened was it was in WIP. Okay, that is work in progress. WIP. Out of this work in progress being Y, since it is still not complete, to what extent this 250 of raw material has gone through the plant? For example, these 250 materials are done with 70% of completion. They're only left with 30%. I should also add the value Y into 70% as when I'm completing, when I'm calculating total equivalent value, no? For 1,000, if my management asks to give me an MIS report stating, sir, what are the number of outputs that you've already produced? I can't say 750, are done and 250 are done at 70%. Rather, they are expecting a number. So what is going to be Y into 70% plus X is going to be equivalent units that I have produced. This is what I'm going to tell them. Ideally, this is going to be on weighted average basis. If FIFO, opening WIP into 1 minus percentage done, plus started and completed, plus closing WIP into percentage done, right? Abnormal gain treatment. Abnormal gain doesn't not does goes on the debit side of the process account because it reduces the cost burden on the goods output. Sir, it is rare, it is not repetitive. When it is not repetitive, why should it go as a burden on cost of goods? It shouldn't. Normal loss on the other hand. Abnormal units are shown on credit side of scrap value. Sorry, abnormal gain. My bad. Credit side of scrap value. This reduces the receivable from normal loss. That is a process costing sum. A pretty basic one. Input. Okay. For raw materials, we have 5,000 as cost. Process cost. Again, process cost raw materials are 1,500. Labor is 2,000. Overheads is 1,000. So total 5,000. 6, 7, 8, 9, 5, 9,500. Okay. Normal loss 10% of input at 5 rupees of scrap. Okay. What should we understand? Normal loss, is it given? Yes, it is. Normal loss expected in case A and case B are 100. That means 10% of inputs at 5% is normal. That means the input is 1,000. That means 10% is going to be 100. So given normal loss, this normal loss are the same since it is expected. The value would be into 5, right? So when I'm calculating cost per unit, 9,500 is already a cost I've received, but the scrap value I should remove, no? Scrap value of the normal loss. That is 500, that is 9,000 divided by total number of units. So should I take 1,000? No. When you take 1,000, there is an estimated loss of 100. So we shouldn't be taking it. We have to reduce it, right? We get 10 rupees per unit as cost per unit. Now let us look at it. Case A, actual output given is 880. Sir, ideally I should get 900. Anything below is abnormal loss. Anything above is abnormal gain. I got 880. That means 120 units of actual loss, out of which normal loss is 100. So abnormal loss, how many units? 20. 20 into 10. See, you're not going to take this 5. Please don't confuse with this 5. That is for scrapping. That is of resale of normal loss. For this abnormal loss, we should always take cost per unit. So 20 units into 10 is going to give us 200. Sir, I told you, if it is going to be beyond 900, it is not going to be abnormal gain. Actual output is 920. We already, that means actual loss is out of 1,000. When my output is 920, I'm only using 80 units. Sir, expected usually is 100, but I'm only losing 80 units. That means 20 units are produced, which is an abnormal gain. It is also going to be valued at cost per unit. Inputs, okay. Normal loss is 500. Abnormal loss is there. Output, the balance checks out. How about abnormal gain? Inputs are given, right? Normal loss of 500, it's still going to be the same. Sir, we are still considering normal loss of 500. Why is this considered? This is the scrap value. Output is valued at 10 and the gain is 200. 9,700, 9,700 valid. So this is what they're going to ask you. They're going to prepare, ask you to, simply show a process account for which you'll have to be very careful and thorough with normal and abnormal loss questions. Coming to contract costing, right? Contract costing pretty straightforward. Completion percentage completion method is what we use. Percentage complete equals to work certified divided by contract price into 100. Notional profit. Remember this formula, very important. Notional profit is work certified minus cost of work done. Work certified minus cost of work done. What is cost of work done, sir? Sir, costs incurred so far minus material on site. This materials on site, it is still not utilized. When it is not utilized, how can we add it to cost of work done? It is still yet to be processed. At a later stage, when we calculate cost of work done, when the material is used, that is the time when we get the inclusion of materials on site into cost of work done. Hence the reason we are reducing it. So why are we reducing it? This cost incurred, for example, there is a site and your your site manager requested 1,000 or 10,000 units to be sent. After receiving 10,000, in your books what are you going to do? Okay, 10,000 units are sent to the costing site, so I'm gonna write down 10,000 into its so and so rate and apply the value. But actually only the after speaking to site manager, you got to know 1,000 of those units are actually not used. When this 1,000 units are not used, this shouldn't be ideally included in the site costing account, correct? So cost of work done, why would I include the 1,000 of unused material? That's the reason why I don't. Again, planned WDV, plans written down value is also reduced. Estimated total cost, cost of work done divided by percentage of completion. Estimated total cost is cost of work done divided by percentage of completion. I've already spent 3 lakhs, sir. I'm up to 30% done, or let us say 50% done. So what is it gonna be? It's around 6 lakhs that I am estimating. Estimated total cost is gonna be around 6 lakhs. Why? Up till 50%, I've already incurred the cost of 3 lakhs. Then, if I'm supposed to do it at 100%, what is the cost gonna be? You cross multiply. That's all, right? Understanding the formulas and the reasons behind is way more efficient rather than trying to by heart them. It is not gonna fetch you uh, under pressure any points, because under pressure you might get confused. Is it cost of work certified or works uncertified? You never know. That is the problem. That's the reason why you have to understand as to what is the background of each formula is. Okay, attributable profit. This is what the question usually revolves around. Sir, estimate profit into work certified divided by percentage completion into cash received divided by work completed. This is for 50%. Ideally, profit recognition rule, we have this. If 0 to 25% of the project is only completed, too early to book any profit. First and foremost, understand, if you have just started with the project, do you think at the initial phase of any project, it's going to be mass pumping and mass, outflow from our end rather than any inflow, right? To get the project running, to get it beyond 25%, you only usually will have outflows rather than inflow. For example, I want to set up a plant. For this plant to be set up, when I get in a lot of machinery, right, to fill the plant, it is all outflow. Am I done completed 100%? No. Initially, when there is outflow, do I get to book any profit? First and foremost, do I even see any sort of revenue generation right away? Probably not, right? That is going to tell us 0 to 25%. It is too early to recognize any profit. So, whenever you check what is the percentage completed, that is work certified by contract price, if it is less than or equal to 25, do not take it. If it is 25 to 50, conservative profit. Sir, how do we calculate conservative profit? Two-thirds of notional profit, which we calculated, into cash received divided by work certified. In some books, they use one third, but we follow based on the question's instruction. So ideally, how does the question give, sir? It mentions it. Let's see if I can find it. Oh, yeah, there you go. This is how our question is. Contract price between two contracts. Work commenced. This is previous year. This is past year. Cost incurred till date 5 lakhs, 13 lakh 50. Materials at store included in above cost. See, materials still on site means they are not utilized. That means we have to reduce these. Work certified by architect. We got work certified. Cash received from client. Cash received. So first and foremost, we should find out what is the percentage of completion. This is of the questions are structured. You are given a profit recognition policy. Below 25% not complete. Complete. Do not recognize any profit. 25 to 50, use conservative method. They also gave you the formula. All you have to do is input the data. This is all you have to do. For that, you have to understand what are the missing figures. You should find notional profit. Cash receipt is there. Work certified is there. So all you have to do is calculate notional profit, percentage of completion, above 50, estimated profit, into work certified divided by contract price, all given, cash received by work certified, all given. For each contract, calculate stage of completion and identify appropriate profit recognition method. Once you get the percentage of completion based on this criterion, you have to understand whether it is on conservative method, whether it is on no recognition of profit method, or we go for above 50%. Okay. Calculate the profit to be recognized, that is attributable profit. For attributable profit itself is the profit recognition policy. Remember that. Not for notional profit. You might get confused. Okay. Calculate the value of work in progress to be shown. Noted. Prepare a contract account for beta. What is beta? The second one. All right. Sir, cost of work done on both contract, cost incurred minus stores. We have already written it down. See, cost incurred. We reduce the materials at site which are unused. What else do we have? Work certified. Contract price. Stage of completion. You have to understand work certified by contract price, you get the percentages, right? This is lying between 25 to 50. This is above 50. So conservative and estimated profit. Attributable profit under alpha. Notional profit. Work certified minus cost of work done. We already know that. Work certified is 4 lakh 50. So what is the cost of work done? Cost of work done for alpha is 4 lakh 20. That means 30,000. Right? So attributable profit is two-thirds of 30,000 into 3 lakh 60. That is cash received divided by 4 lakh 50. Is the cash received 3 lakh 60? Cash received for client 3 lakh 60. There we go. See, the question is going to be easy. You just have to break it down. Then contract beta. Similar. Work certified, so and so, so and so. Total cost, estimated total profit, attributable profit. You put in the figures, you get it. Work in progress done. Sir, this is something we can show you. Contract beta account is pretty straightforward. Cost of work done, we already got. Your attributable profit, whatever is to be recognized, you already recognized 16K and 2,70K, right? Plus cash received from client. That means out of the 4,20,000 of cost, I recognized 16,000 to be attributable profit. So I'm gonna put it aside. And I also know I've already received payment of 3,60,000 against the 4,20,000 that I had. That means balance left is only the work in progress that I should show on the balance sheet, right? Notional profit equals to work certified minus cost of work done. Okay, probably here for this they must have showed it. Yes, 3 lakhs is deferred. All right. Okay, job cost, direct material, direct material, direct labor, overhead at overhead absorption rate plus profit margin if required. Cost per kilometer, transportation, total operating cost, so on and so forth. Equivalent room days, whenever there is a unit of measurement and there is by unit of measurement, that is, customer distance per kilometer, or, time spent against time traveled. In this, in those cases, you will have to remember these formulas. Rooms occupied entities. Those are gonna be very basic sums. These are our concept. No, common sense oriented. I think you guys can figure this out. Further processing decisions, incremental revenues greater than incremental costs. When okay, just to again, pinpoint this. Whenever they're asking, should we grow further in the process, or should we shut it down? If the incremental revenue is greater than the incremental cost, then you can always go for it, proceed further. Right, now comes our beautiful favorite chapter, marginal costing and CVP analysis. Along with this, we also have our another favorite, beautiful, beautiful chapter, standard costing. I'm going to take you guys through a master example for standard costing. But in the meantime, what we'll do is we'll look at the very simple sums from marginal costing and CVP analysis, right? Remember, marginal costing, even if they're asking for transfer pricing, ideally they won't. It is asked at the final level. If they are going for very basic calculations, all you have to do is understand these formulas, and once you are thorough with these formulas, it is going to be very easy. Sir, break down the formulas, write it twice or thrice if you don't get the concept behind them. Contribution, sales minus variable cost. Okay, let us first start with this. Sales minus variable cost, we get contribution. Contribution minus fixed cost, we get profit. This is a very standard format. Once you know this, you get it. So what is contribution? Sales minus variable cost, yes or no? Second part, sir, contribution, for example, let us start with figures 100, 30. Contribution is at 70. Fixed cost is at 40. We get profit of another 30. Yes or no? Am I not, making simple sense that sales minus variable cost is contribution? And to get 70 from the bottom, if I have to come up, 30 plus 40 would be giving me 70. That means fixed cost plus profit is going to be contribution. Understood the first formula? Please write such things down. It's going to be pretty easy. Okay, I shouldn't have erased everything. Okay, so, sir, PV ratio. What is profit volume ratio? Contribution by sales. PV ratio is contribution by sales into 100, right? Change in contribution by change in sales as well. So C1 minus C2 by S1 minus S2. Contribution 1 minus contribution 2, that is the change. 1 and 2 denote the change, right? Sale 1 minus sale 2 is also going to give you PV ratio. These are going to be very useful once you have these formulas in your mind. MCQ's part is going to be really easy. Ideally, they might give you one missing figure and they give you the rest. You have to figure out what is the relation. If you write it down in an equation, it would be pretty easy. Okay, so BEP. So what is BEP? BEP is break even point. Break even point is a point at which there is no profit or no loss. That means I'm producing 100 units, right? For 100 units, if I'm revenue generation is at 1 lakh, this is going to be the sale value. My total cost is going to be also be at 1 lakh. No profit, no loss is where we get BEP into picture. Okay. BEP is no profit, no loss. So whenever you're starting a business, your first target should be to reach BEP. That means all the incomes that you have are set off against the expenses. That means nothing from your end is a loss. You're not putting beyond than what you receive. Okay, so BEP formula in units. Total fixed cost. Total fixed cost divided by contribution per unit. Okay, so total fixed cost by PV ratio would be giving us value. Here we are using contribution per unit. Here we are using PV ratio. So what is margin of safety? Margin of safety is there is an actual sale and then we already calculated BEP sale. The difference between actual sales and BEP sales is known as margin of safety. This is where your profit generation is, because BEP sales give you no profit, no loss, and actual sales is the entire amount of sales. Once you reduce the chunk of it, that is the BEP part, the rest is going to be MOS. Sir, how do I calculate percentage of MOS? I don't have to explain it to you, sir. Actual equals to BEP plus MOS, yes or no? When you need percentage of MOS, MOS by actual into 100. Simple. Profit divided by contribution is another way to calculate it. Profit divided by contribution. You might not get this, but this is a very important formula that in MCQs you won't remember. Profit by contribution gives you MOS. All the other data might not be given. Maybe they can give you sales, variable cost, and profit. They ask you what is MOS, right? Then you have to use this formula. Contribution comes by sales minus variable cost. Profit is already given. Profit by contribution is going to give you percentage of MOS. On base of percentage of MOS, if you multiply it on actual sales, you get MOS. Once you get MOS, you might get BEP. So this is how they can structure it. They might ask you the endpoint as BEP, or they might give you a master question and the sub MCQs maybe 4 or 5. They ask you each of them one by one in separate MCQs. Then profit equals to, again, profit equals to, remember MOS percentage is profit by contribution. MOS percentage equals to profit by contribution. That means profit equals to MOS percentage into contribution. Sir, what is MOS into PV ratio, sir? If you start expanding it, MOS divided by sales, right? Then the sales is at bottom. Contribution by sales is PV ratio. What is this, sir? MOS by actual sale, yes or no? So can I just write sales into contribution equals to profit? Sir, we already know contribution by sales is PV ratio. So PV ratio into MOS equals to profit. What did I tell you before? So PV ratio is a percentage of profit on sale, yes or no? When I know that BEP doesn't give me profit or loss, that is no profit or no loss, then MOS being the other part is going to give me profit. But MOS is sales, sir. On MOS, if I multiply the PV ratio, here profit is zero. Here, whatever is balance, whenever I'm multiplying PV ratio, am I just getting the profit part? Because actual sale is equals to MOS plus BEP. You get it? So what should I look at next? Just give me a second. I'm gonna be back. All right, I'm back. So, sir, what is absorption costing? What is marginal costing? We already looked at it. Absorption costing doesn't differentiate between variable and fixed, whereas marginal costing ideally only looks at variable costs. We looked at it in chapter 1. So, we're still yet to get through with this part. Sure. Okay, target sales. Sir, target sales, how do we get it? Fixed cost plus target profit divided by PV ratio. Again, expand this formula. PV ratio equals to contribution by sales. That means fixed cost by sales into contribution instead of this. Yes, contribution by sales, my bad. So sales would come onto the top and contribution at the bottom. Sir, how am I getting this, sir? Even for the shutdown costs, I don't think if they've given a shutdown cost. Never mind. There is going to be a shutdown cost question as well. I'll write down the formula. Target sales is similarly, whenever units, we use contribution per unit. Whenever it is amounts or values, we use PV ratio. So what is shutdown cost that you're talking about? Okay, there is a plant. I'm already making a loss out of it, okay? If I have to shut it down completely, I'm gonna spend 10,000, right? When I'm already spending 10,000, to what extent of sale can I make to justify me not shutting down, right? The similar case would be fixed cost minus shutdown cost divided by PV ratio. It's going to give me the shutdown sales. Beyond that, if the sale is going down, then I'll have to stop the plant and go for a shutdown. If not, until then, if the sale is sustained at the shutdown sales point, then I can continue it, right? Similar, instead of the fixed cost minus shutdown cost, if we add the required profit, which the question might give, you get the required sales at specified profit, that is target sales, right? Similarly, shutdown cost, if you need the number of units to be sold, instead of PV ratio, you use contribution per unit. Weighted average PV ratio, total contribution by total sales, that is for multiple products. If you want an overall portfolio's PV ratio, you just do a weighted average. Limiting factor. Factor is basically a bottleneck. Okay. Sir, why is it written contribution per unit is used for limiting factor? Understand something here. When I wrote fixed cost, isn't fixed cost gonna be common? It's gonna be common, right? So whenever we are touching fixed cost point and going to it, the value above it matters rather than the value below it, correct? So this is where we have to stop for a decision making. And the last one that we see is contribution, not profit. That is why whenever we see a limiting factor question, we never rank it based on profit, we rank it based on contribution per unit of limiting factor. We can look at one sum if I out here. Absorption and marginal reconciliation again is still going to be the same. Okay, very basic question. BP, okay, sales is given, variable cost is given. So contribution is 40, 100 minus 60. Fixed cost is 2 lakhs. Actual sale units. You can either reduce this to number of units or you can multiply 8,000 into contribution and you get total contribution value. Then you get actual profit. Contribution is received. PV ratio 40 by sales, 40%. BP equals to 2 lakhs, that is the fixed cost, divided by contribution per unit. There we go. Value 0.4. We get 5 lakhs. So MOS is going to be actual sales is 100 into 8,000, 8 lakhs minus BP, that is 3 lakhs. Profit 3 lakhs into 40%. Did we not just talk about it? Where is this? Yes. Okay, I think I've erased it. Above BEP, if there is any sale, is always gonna be profit is always gonna be derived only from MOS, not from BEP. So that's why profit equals to on 3 lakhs, you can just apply 40%. You can get 1 lakh 20. Target sales after profit. They've received a target, I mean, tax rate is given. Uh, the question didn't specify it. Target profit after tax is 1 lakh 60, it seems. That means pre-tax, it's gonna be 2 lakhs. Remember, profit after tax. This is not something we consider. We have to calculate PBT, profit before tax. To eliminate the component of taxes where you have to mainly focus on never take profit after tax 1 lakh 60 and calculate the problem. It's going to be wrong because we need an overall profit after tax. Whenever you're taking this in consideration here, that means the number of units are going to be going down. You have to take profit before tax, that is PBT. This is one point where a lot of you might make mistakes. I certainly probably did it back when I was an intern. Okay, let me try to find one problem for marginal costing. PV ratio, BEP, margin of safety. Due to market down, sales are expected to drop. Calculate new profit. Fine. These things you guys can manage. Company wants a target net profit of 1 lakh 20. Okay. After paying income tax. Net profit after paying income tax. So before tax, you should calculate. Fixed costs are expected to increase 80,000. Great. Assuming sales even not fraud. Okay. Calculate new BEP. Fixed cost itself is changing. So fixed cost by PV ratio gives you the new BEP. So old fixed cost plus 80,000 is gonna give you the new BEP, right? Marketing team proposes cutting the selling price by 20 to boost demand. Okay, sales increases, sale price increases, demand increases. Estimate value of sales would be increase 6,000. Okay, number of units is increasing where the cost is reducing. Should the company accept this proposal? You just evaluate. Okay, let me look at this. Price reduction proposal. Selling price is at 200. Since we've reduced, it is going to go to 180. Variable cost is obviously going to be unchanged. We have changed the sale value. Total variable cost is going to increase because the number of units have changed. Contribution per unit. Okay. Sales volume is from 5,000, it has gone to 6,000. So total contribution, okay, less fixed cost, profit. When you reduce the price by 20, but increasing only the units by 1,000, it's not going to be any sense, you know, because it is reducing 40,000 of our profit. So current plan should be gone with. Okay. One major mistake I see a lot of you guys doing is you get all this done, you ignore the recommendation part. Writing this in clear words, making proper sentences is very important. Recommendation: reject the proposal. Despite selling 1,000 units more, profit drops by 40. The price cut reduces the contribution per unit by 20 itself. Since the variable cost per unit, see, this is per unit, total variable cost is going to change, right? If the number of units are more, you're selling more means you are also producing more. That is going to change, but variable cost per unit is never going to change. Based on output, fixed cost per unit is going to change, not variable cost per unit. So contribution per unit is reduced by 20. The volume increase in 1,000 units is generating only 60,000 of additional contribution, but reducing the rate at 5,000, sorry, reduced rate on existing 5,000 cost at 1 lakh as lost contribution. The net effect is worse by 40,000. It is just the breakup of 40 as to how it is, affected. Why are we getting 40 is this says the cost is of 1 lakh, but additional contribution is only of 60. That means we are getting a net of 40. But this is only for the additional 1,000 units we're talking about. For the rest 5,000 units, I already know I'm generating a profit of 80K. So this 80K being net set off with the 1,000 additional units generating a loss of 40, this is gonna reduce my overall profit to 40,000, right? So very important to write down the recommendation at the end. Sales variance, profit reconciliation. This is into standard costing. If we have any other problems here, I'll look into standard costing in a bit. Okay. Uh, this is ILO method. Chapter 1, I've covered it. That is very similar. High cost minus low cost by high cost unit by low cost units. Okay. Then we have to do a variance analysis. Right. I'm also gonna show you through the first PDF. We'll not be solving it today. We don't have time. Okay. Just to give you through a brief. So what is overhead absorption rate we know. So what is blanket rate? So blanket is basically application of just one rate across all departments. Okay. This blanket rate is application of one overhead absorption rate throughout the entire entity. See, company operates in two different departments. Department M, machining, and Department F, finishing. Whenever we are using blanket rate, for these, we already know that we have separate overhead absorption rates, correct? This overhead absorption rate being separate is not going to be the case when we calculate blanket overhead rate. Then we are asked to prepare job cost sheet under overhead, under absorption with a supplementary rate, so on and so forth. Actual data, departmental, blanket rate. Okay, the basis is already clearly given. So for both departments combined. Okay, this is standard. You just pick up the numbers from the budget. Budgeted overheads 2 lakh 40. For department M, it's gonna be machine hours. For department F, it's gonna be the labor hours. Where is it given, sir? Here. Use machine hour rate for M, direct labor head rate for F. We get the overhead absorption rate, blanket rate. We are clearly instructed to use direct labor hours for both. So 2 lakh 40 divided by plus 1 lakh 80 is 4 lakh 20. That is the total. And total direct labor hours is going to be 10,000. So for 42 is going to be the blanket overhead rate. Okay. I'll say in row one, you guys can do it. You just have to input the given values. Unintegrated, we already looked at it. And go through this being another sum. Okay, I think this is a variance problem. What have we required? Okay, for reconciliation. Right. Okay, raw materials purchases on credit. Okay, materials straight to stores, wages, so on and so forth. Prepare a costing ledger. Okay. Extract trial balance. Prepare a reconciliation statement. If you go through it, working notes, overhead absorption rate, total overheads under absorbed, and total value of sales. We just calculate the basic requirements. Then you start making the ledgers, raw material control account, work in progress control account, finished good control account. Ideally, costing we use this word control account at the end. So kindly do write it just to maintain the uniformity, and the examiner is going to be super happy. Costing P&L, cost ledger account, anything that you write it over here is obviously going to balance out in the reconciliation statement. Okay, anything else? Module 5, FIFO LIFO. Okay, materials have a conversion rate. Equivalent production, I told you, right? So for the balance, which is in WIP, based on the completion, sorry, based on the WIP, based on the percentage completion is where it has to be valued. And it is the weighted average method. Statement of equivalent production rate. You guys can go through these sums. Limiting factor analysis, let me just go through this. Contribution is directly calculated. The machine hours is the limiting factor. Probably total machine number, total machine hours are going to be, a scarcity. Okay. Okay. Available machine hours is 8,000. Maximum demand 1,000 into 3, 3,000. 1,200 into 4, 4,800. 2,000 into 2.5, 5,000. Right? Total is exceeding 8,000 hours. You can't have all products produced under the available hours, right? Since the limiting factor is machine hours per month, You have to use the contribution for that specific product, see how many machineries are being utilized. You calculate the limiting contribution per limiting factor, because the bottleneck here is machineries. 60 divided by 3, 20. 84 divided by 4, 21. 45 by 2.5, 18. Now, which is the highest contribution is what we should see. Kindly don't blindly go with contribution per unit. Limiting factor is the major concern. So, see what is the applicable limiting factor that the product utilizes, or that business utilizes, that departmental utilizes. Based on that, calculate contribution per limiting factor, and then you get the final values. Okay. So priority rank 21 higher, 20 followed by 18. Right. First priority which should be given to product Y, second is to X, third is to Z. So maximum how many can be produced, you produce. If there are balanced number of hours left, then you go for the last final product which is yielding less. Then you just calculate the profit statement based on contributions and units. You multiply less fixed cost, you get total profit. You already know this format. Make or buy dish. Component P, 1200 units needed, it seems. We're only talking about XYZ. This is part 2, so it's a different question probably. Part B, make or buy products. Currently it's manufactured. Direct labor, material labor and overheads, variable and fixed, not apportioned, not avoidable if we buy. So even if we buy, we cannot avoid this 5 rupees, it seems. An external supplier offers component at 42, evaluate whether we should make or buy. So what you do is you calculated contribution per unit, right? Irrespective of this, you're getting this, product. Okay, actually, you reduce this, so we get 40. Variable added 40, fixed over it, not avoidable, so excluded. So what is sunk cost? Sunk cost is an irrelevant cost, sir. That cost will incur irrespective of making a decision or not. Irrespective of both decisions you go for, you have to incur that cost. Okay. For example, uh, let us take an example of rent. You need rent for warehouse, whether you produce yourselves or you purchase from outside. So, is the rent gonna change based on the decision I'm taking? No, it is gonna be unavoidable, right? So you do not consider it. External purchase is at 42. This is at 40. So ideally, you're saving 2 rupees when you're making it. So outright in the question itself, you know what is to be done. Make or buy. Recommendation. Remember, this recommendation is very important. Even for this, I would really ask you guys to write it down in, proper sentences that, okay, this is why we are taking so and so, despite the examiner, having the view of the table. You guys prepare, do write it down in words. Variable cost per unit is 40, external is 42, fixed overhead is apportioned and will continue regardless. Hence, it is an not a relevant cost. If it were been avoidable, okay, for example, a machinery you take and the depreciation on that machinery is going to be fixed part, irrespective of your production. So only when you make it, it's going to be fixed overhead that can, be included for you this. Then if you then it would be 45. In that instance, you will not go for make, you would rather buy it, because you are losing out on 3 rupees by manufacturing it by yourselves. Total relevant cost of making 45 is greater than external. Then the decision to reverse, that is to buy. Shutdown cost. Sir, I've already showed you this. Total contribution, right? If we discontinue, what is the instance? If we don't, what is the instance? Common fixed costs are written. Avoidable costs for Z, 5,000. If you discontinue, you don't have it. Profit is, achieved. Common fixed cost. You probably have to see the question to understand why the figures are taken as such. Recommendation: discontinue product Z. Uh, Product Z contribution, is less than its avoidable fixed cost of 5,000. Shutting down sales as 1,400 net. Missioners are freed up for 200 hours. Cannot yield more contribution. Like, either to do X or Y. So this is to continue Z or not. So X or Y either ways have to be fully met, it seems. This is probably for this. Not sure. 6C problem. This, I think. Okay, this is budget. Budget costing is like you just have to get down all the data from the question and process it to get another figure. It's more or less going to be pretty easy. Sales, desired stock, less closing stock, liquid production, right? Closing stocks you find, purchase material, material purchase budget, 2 into production, it seems. So all the data in the question, it's just, have to be a little modified and you would ideally get through with the budgeting question. The problem here is it's going to take you time. So when you're starting out a question, remember if you're getting stuck with any question, more than 5-10 minutes, you don't know what to do next, either read what is required in the end again carefully. If you're not able to get two, but you're able to get three, solve it, go to the next question. If not, ignore that question, abandon it, it's fine. You can score somewhere else rather than you wasting your time in the same question. Okay. So these two, master sums are also shared in the drive link. So please do access them. So let us quickly get through with the standard costing. I've made another, proper notes for standard costing. I understand a lot of you find a lot of trouble uh, memorizing. If you already have trouble, memorized everything properly, this is not for you. You can, leave the session at this point. Maybe in the last few minutes, I might give you some insights. But for those of you who want to understand a little concept, I'm going to try to build some concept here. Let me see how much charge do I have on the pen. 7%. Right. I'll try to make it quick. Okay. So what is standard costing? So standard costing is, for instance, okay, my mom has told me to purchase, for example, 1 kg rice. Okay. For instance, let us say it's basmati rice. Okay. And she gave me around 200 rupees. She didn't have change. She gave me 200 rupees. So ideally, what is the standard that she expects me to, do as an expenditure? 100 rupees. But I went to the shop and he said 110 rupees. This is the actual. When I come home and my mom asks, give me the change, I put her 90 in her hand, she's going to ask, how much did it cost? 110. Why? Right. Or I might also just do an expenditure of 100, but also actually purchase something which is not useful for myself. Maybe I do it a lot. So in such cases, she might again ask, you gave me 90, but ideally it should have been 100 that you should have been given me back. Why is there a difference of 10? Right. This is what standard costing is. What should have been the cost versus what cost has been incurred, right? This variance calculation is all for standard costing, right? To understand what should have been the cost or what, ideally should, and versus what is actually spent, the differences when we look at is where standard costing comes into picture. Let us understand, sir. I know there is mix, there is yield, there is rate variance, there is price variance. Then we have different sorts of other variances based on volume, etc. Right? Efficiency variance. So help me understand what is actually. I mean, where exactly do they fall, and why are we taking them? I'm gonna give you a very brief with an example. Okay. So let us say you have a super cool hotel. I know the drawing is great. Right. So in this super cool hotel, you have only one product. Okay. The product is everyone's favorite, biryani. Right. So biryani needs rice, masala, onions, tomatoes. Right. If you're non-vegetarian, chicken, mutton, or if you're a vegetarian like me, paneer, etc. Right. So there are various components that go into biryani. Right. I'm the owner, and you guys are the probably the store manager, where your goal is to get all the required items. And since I've been in the industry, I tell you the standard, okay, for one plate of biryani, I need 200 grams of rice, that is basmati rice. Okay. And I also know, based on the market, rice is at the rate of 50 rupees per kg. And I also know, to cook it, it requires 30 minutes of cooking time. Sir, if I'm talking about cooking time, here I'm talking about gas, which is a consumable. I'm also talking about labor, which is my employee cost. That is in form of wages, right? Wages, salaries, be it anything. This is the standard, right? I told you to look after the shop. What I did, after 1 month, I wanted to understand what was the actual, because I already know what is the standard. I wanted to see what the actual was. One plate of biryani, right? I noticed you told me, sir, not 200 grams. I used 220 grams of rice. I was like, okay, fine. I thought maybe he's using more, but he reduced on price. He was like, no, no, sir, I used rupees 52 per kg and got rice. Okay, fine. What is the cook time? I asked. You said 35 minutes. I was like, what? Then my question was, remember, from 50 to 52, from 200, sorry, from 200 to 220, from 50 to 52, and from 30 to 35. I see a lot of deviations from the standard and actual, correct? So I sat with you. First question I've asked you is, did we pay right price? Second question I asked is, did we use the right quantity? So if you're using the same, quantity, cook time should be same. If not, if only if you've increased the time, cook time would have increased. That means quantity, did we use it the same or not? Right. Question number three. Did the inputs combine in the right way? That means you added probably more of meat to it. Meat requires high time to cook. compared to regular rice, paneer, and mushroom, beet, any other thing, right? So, with these questions, what I understood is when I'm talking about price or the right price, I understood price and rate variance. And I'm talking about right quantity, I understood usage and efficiency variance. When I'm talking about combination, I understood mix and yield variance. Okay. I know that standard cost is a planned cost to do something, but actual cost varied from the planned cost. Then I have to figure out what is going on. Then I ask these questions. These questions have told me when you're talking about right price, we talk about price and rate variance. Am I paying the laborer also the same rate? It's not just about material, remember. It also includes regarding variable overheads as well, fixed overheads as well. When I'm talking about right quantity, did I use it right? Was my efficiency good? Efficiency good? When the inputs are combined, is the mix ratio right? 1 is to 2. If I had to do that, did I do maybe 1 is to 2.5? I have to question it, right? Or did I do 1 is to 0.75? All these questions should be asked. When you're talking about yield variance, okay, you put in around 1 plate rice or 10 plates rice. Did you get 10 plates of output or did you only get 9 plates of output? The yield. Did you maybe burn something that you had to throw it away where the yield has reduced? All these questions rise me to these points and these points rise me to their respective variances, right? I hope with this biryani example it is clear where and how these come into picture, right? Okay, one basic understanding one should know what is favorable, sir, what is adverse, sir. What is favorable, what is adverse. When we're talking about cost, actual cost is less than standard cost. Okay, you got the same rate, I mean same plate of rice, but at the rate of 48 per kg. Would I be appreciative? Oh, wow, wow, very good, well done. You've bargained really well. You reduced rupees 2 as my cost burden. So, when the actual cost is less than standard cost, is it not favorable to the business? Spent less than planned. Actual output more than standard output. I gave you quantity for 10 plates, but you used your, tactics. You served it in 11 plates. You got me 1 plate extra as an output. So when actual output is greater than standard output, produced more than expected, is it not favorable for me? It is. When we talk about sales, it flips. When actual price is greater than standard price is what we should do. When you're talking about cost, actual cost price that we're paying should be less compared to the standard. When it's sales, it should be more. For example, he's supposed to sell it at maybe 180 rupees. He sold it at 200. That means actual price being more than the standard price is not beneficial to me. Got a better price per unit sold. So what is adverse? A lot of you actually, get a lot of confusion here. What is favorable or what is adverse based on the figure you get. For that, you understand what variance are we talking about. Is it sales variance? Is it labor variance? Is it like material variance? Okay, are we talking about rate? Are we talking about efficiency? Are we talking about mix, yield? Based on that, when you understand the background concept, you know the figure you get is either favorable or adverse, right? Adverse, not bad. It is just going to be exactly opposite of favorable. Actual cost greater than standard cost, actual output less than standard output, and sale price is less than the standard sale price. Now, did we pay the right price, right rate, right quantity, right hours? Inputs correct? Price, rate, usage, variance, material yield, and mix and yield variance. Okay, we'll actually look at the sum and we will start solving right from the bottom. Okay, the master problem here, we're close to 15 minutes. Okay. I'll try to wrap this in 15 minutes. Okay. So this master problem, wherever you see in the pink box, is based for the solution for the master problem I've created at the bottom. Okay. We have all the variances, do not worry. Before we go to the variance part, let us also look at the reconciliation. So budgeted profit to actual profit variance one at a time. Favorable variances we always add, adverse variances we always reduce. That is all you have to know, right? From budgeted, we come to actual. Adverse we less, favorable we add. I did for those of you, who wish to prepare and go for the exam based on the ABC method or the institute's format where 1, 2, 3, 4 are given. You remember the formulas like 1 minus 4, 1 minus 3, 2 minus 3, so on and so forth. You also have that. But those who want to understand the concept based on the formula by looking at an example, you're more than welcome. But remember, in the end, whichever method helps you out in the exam for you to get through the exam, please do it. It's not a bad thing to by heart, but if you have enough time and you think you can do it, please go for it. Okay. Final problem, master problem, Zenith Industries. Okay, this is a combined problem covering mixed yield, labor, fixed overheads. There is a four type variance, sales variance, and a full reconciliation. Okay, all of them, or at least four of them, are usually combined into 10 plus 10 or 14 marks, you know. So while calculating the variances, if you understand what is given, it's easy. So there are going to be questions where if you already know the formula and there is one missing aspect out of it, and you have to interlink different formulas to get it, that is up to you. You have to, practice more in those terms. But overall, with a point of master problem, all the data is going to be given and all the variances are to be calculated in this. Okay, start with the standard cost card. Material, we have alpha and we have beta. And labor, we have, type 1 and type 2. Anything else? Okay. Material alpha, 3 kgs at 40 per kg. Total amount. Beta, given. Total material, 5 kgs for 1 unit. No process loss, it seems. That means no normal loss. Whatever inputs you're giving, 3 plus 2 is going to give you one level of output. I mean, 1 unit of output for sure. So total material cost for 1 unit of output is 120. Now labor. 4 plus 6, total 10 hours of different sorts of labor we are using. 10 hours labor rate per unit is going to be, for 10 hours, it's going to be 380. Have 4 into 50, 6 into 30. Total for 10 hours is going to be for the total labor. Variable overheads also given, sir. Fixed overheads also given. Standard total cost is the summation of all these, right? Standard selling price also given. Standard profit is also given. Now, similar to what the biryani problem has, 200 grams, 50 rupees, and also 30 minutes of time, we have to now compare the standards with actuals. There is also something given. Budgeted projection in sales is 400 units. Okay, so we need 400 units. 400 units means we need how many of material alpha and material beta? For 1 unit, we need 3. For 400 units, 3 into 400, that is 1200 units of material alpha and 800 units of material beta we need, right? So 1 unit, we need 2 kgs. Fixed overheads also given. Remember, this is the standard. This is the total. Working days, 25 it seems. Budgeted hours, 4000. Great. So fixed overheads, we can just calculate here. 3,80,000 divided by 4000. It gets the overhead absorption rate, always based on budgets. Actual data for month. Production and sales. 360 units sold. Okay, 360 units sold. They told 400. We sold I mean 40 units less. At the rate of 2050 per unit. What is the standard sale price? 2100. So we see a difference of 50. See how I'm linking. Sold at. Standard selling price is 2100, but we reduce the price. We also reduce the quantity. Actual working days 24, it seems. Ideally here 25. That means the calendar days are going to be changing. That means we should calculate revised standard quantity, revised standard hours, so on and so forth, because the working are different. Material purchase 1200, it seems, and 1800. Is that what we want? Yes. Rates are different. 40 and 60, 42 and 58. For alpha, we see an increase of rupees 2. For beta, we see a decrease of 2. See, right when we are reading this question, we already know what it's going to be when we calculate for that specific variance, which amount to be picked up. The main point in solving such questions is to break down the question to understand which amount is going where, what should I tag it to. Alpha used and beta used. So ideally, how much should be used for 400 for 360 units? 360 into 3 is what I should use for material alpha, that is 1080. For beta, how much should I use? 360 into 2, that is 720, right? 360 into 2, 720. Perfect. But what have they used? See, what did I do? Based on the production, what should they have been used? 3 of alpha, 2 of beta per kg, per unit. Into 3 gives me this, into 2 gives me this figure. But that means for beta, they've used around 50 minus 20. They've used 30 kgs more of beta. And they've also used 20 kgs more of alpha. That means usage is bad. Material variance one way is bad. The other way it's in favor because we purchased it at a lower price. Then let us look at grade 1 labor. Hours paid. See, remember, hours paid is not equal to hours worked. Sir, why, sir? I'll give you a brief example. Let us say I go to a 9 to 5 job. Okay. Or let us say 9 to 6. When I go to 9 to 6, I'm in the office for 9 hours, correct? In this 9 hours, I get paid for 9 hours. For let us say daily, I get 1000 rupees paid. Okay. In this 9 hours, do I not have lunch break of 1 hour maybe? 0.5 hours, that is half an hour for washroom breaks, snacks break, tea breaks, having fun with colleagues. My productive hours of working is 7.5 hours, yes or no? That means I'm being paid for 9 hours, but my actual working hours is 7.5. Hours paid 9 is not equals to hours worked. Makes sense? That means hours paid equals to hours worked plus idle time. Idle time is how much, sir? 1.5 hours. 7.5 hours equals to 9 hours. See? Common sense. It is not rocket science. Okay, so let us understand. How much should they be working? 4 hours per unit and 6 hours per unit. So grade 1 labor, they should work 4 hours per unit. That means 360 into 4. 1440 hours they should have worked for grade 1 labor for 360 units. This is all based on 360, that is the actual production. And what do we see? Around 6 hours for the other. That is 2160 hours. To produce 360 units, these are the number of hours they should be using or utilizing. How many did they utilize? 1500 hours, which includes idle hours of 100. That means they need 1440 hours. But they've completed the work in 1400 hours itself. Are they efficient? Yes, they produced it less than the standard number of hours. That means they have done it efficiently. If we are removing idle hours, because here we don't see any idle hours being included in grade 1 and 2 labor when the standard is given. Similarly, 150 hours idle hours, that means 1250 hours they have taken, wherein they are supposed to take 1260 hours. There could be two possibilities. Either the quality might have been compromised, or they were super efficient that they will reduce the number of hours worked for 360 units. Okay, sir, what is the rate? 52 and 28. 50 and 30. So again we see 2 rupees increase and 2 rupees decrease. Okay. Actual variable overheads is 73 it seems. What is the standard that they mentioned? Ideally should have been for 400 units. I mean for, okay, 200 per unit. So 200 into 360, my overhead should have been 72,000 based on 360 units produced, because 200 is the rate per unit. But what is actually producers? 73. I mean, what is the overhead cost that we have incurred? 73. Fixed is 3,94,000. But did they not already give us? Fixed overhead based on budget is 3,80,000. We already calculated the overhead absorption rate. Fixed overheads is 950 per unit. 950 into 360. So it should have been 3,42,000. Sir, we already analyzed the entire question. There is no line that we have left. Now let us look at what is he asking. Calculate all material variances, including mix and yield, using ABCD table formula. I'm not going to do this. I'm just going to briefly explain you why the formula is used in what sense. Calculate all labor, including time, mix, and yield. Again, not ABCDE. Variable overheads, fixed overheads using 4 variance analysis. Okay. Calculate sales variance using profit method. Okay. Complete reconciliation statement from budgeted profit to actual profit. Verify reconciliation against actual profit computed individually. So he's asking, since this entire actual data is given, cost is given, right? Sale value is given. Reduce those. See if the actual profit you get from this data is matching from the reconciliation profit. If you look at the question, independent verification, actual revenue, total cost, actual profit, we get 38,900. So when the reconciliation is done, when he started from budget, reducing sales variance, okay, volume variance probably negative, hence we reduced standard profit on actual variance, add less, okay, we get adverse, we reduce it 38,900. Now let us verify if these figures are correct and how we do them. Okay, shall we go bottom up? Why not? Sales variance based on profit method. Okay, you guys need a little more assistance with this, I understand. Right. So sales variance, there are two methods, right? First and foremost, when can sales go wrong? When there is a price difference or the quantity difference. Remember in biryani, I told you he sold it at 200 instead of 180. He could have also sold it for 160. Price variance. Quantity variance. There are probably 10 plates produced. He could have sold all of it instead of letting it spoil. Probably he was not able to sell the right quantity. Or he split it into 11 plates and sold all of them without any wastage. Then also quantity has changed. Those are the cases when we see sales variance occurring. First understanding is why a variance is occurring, what is the background main reason behind it. Okay, sales price variance. Actual price minus standard price into actual quantity. Makes sense. Put in data. Remember, we already wrote it down here. 2050, 2100. This is the standard, this is the actual. All the figures that you see at the bottom are just, pulled in for each and every specific part you're reading. The reason why I have put it like this and also given a solution for those who use the ABCD formula is when you're understanding the concept, it is pretty easy for you to pick up figures, put it in the concept you already know, and derive the required results. See, this method, what I'm teaching, is only for those who are already used to it and want to practice it before the exam. If anyone is in the opinion, okay, I only want to go for ABCD method and don't want to go for this in front of the exam, right before the exam, I would also suggest you do that because right now learning standard costing is not something you should be attempting of. In fact, if anyone wants to leave standard costing as an option, don't kindly, blindly remove everything and don't even look at formulas. No, please kindly look at least material, labor, fixed, variable. Ignore sales. These on a very basic understanding level, if you get it, great. If not, just listen to the lecture. If any point conceptually is sticking to you, you can probably solve an MCQ which is giving you 2 marks. Who knows? A paper might clear or a group might clear with those 2 marks. So kindly don't completely skip it unless you don't have time at all. There are various other scoring points which you can utilize. I'm out of water and we are at 5% touch. Okay. All right. So we know the reason why there could be a variance. Let us understand. Profit method is one method that we usually do. The other is the revenue method. ICMA basically only follows profit method, right? Sales volume variance. Volume variance, quantity is differing. What is the differing? Actual quantity versus budgeted or standard? Budgeted, because we anticipated that number of production and sales. Remember, in the question also, we are talking about budgeted production and sales. We don't ever see the standard production and sales. Sir, why would there be a standard production and sales? It should be always a budget, right? You always plan for your production and sales. So whenever you're going for sales volume variance, it is gonna be budgeted quantity. Again, standard profit per unit, we see the figures. 360 minus 400, we already saw the difference. This is the actual, this is the budgeted into the price, standard price. I don't remember the standard price. Is it correct? Yeah, standard sale price. We didn't completely look into it. So 330, and that's there. Sales volume basis and revenue method. If you want, you can go through it. They use standard selling price instead of profit. Simple. Profit, you go for profit. Revenue, you go for sales. That's the only difference. This is the sales volume variance. Sales variances. So now let us look at material. Why did I come to material? You have to understand the revised standard quantity. Okay. Okay. Sir, in an entity, a manufacturing entity, there is going to be a production manager, there is going to be a purchase manager or a procurement team. Okay. What usually happens? They get a contract from the business team. They say, okay, we have an order, we have to deliver. That information is immediately relayed to both these parties, production as well as procurement. Procurement guy, what he does, he deals with external parties, right? Quantity internally, this guy deals how much has to be produced, what is the C on standard input number, output number, or BOM, that is bills of materials, right? So what he does, he deals with quantity. He deals with price. Why? He is dealing with the external vendor, so he knows the price fluctuation. So whenever we are asking about price variances, should we ask the production manager or the purchase manager? Obviously, the purchase manager. Similarly, quantity going in, the output, the differences, the mix, the yield, all should be asked for the production manager or the purchase manager. Obviously, production manager. Purchase manager controls the price. Production manager controls how much is used. Right? What is material cost variance? Material cost variance is material price variance plus material usage variance. Again, usage variance is split. Before we go there, let us understand what is revised standard quantity. Total input, actual input for standard proportion of each material. It holds total quantity constant while forcing the standard ratio is the revised standard quantity. This is a very rubbish way to put it. I understand it, but it is not that easy to understand it with the given articulation. What it usually says is, sir, we know 3 is to 2 is alpha to beta ratio for 1 unit of product. Oh, did I go extremely down? Right. 3 is to 2 here. 3 is to 2 here is the alpha to beta ratio for 1 unit of product. When it is at 360, revised standard quantity is going to be how much? For both of them, I should calculate, no, sir. Ideally, what did I think? It's going to be 1200 and 800. But what did it turn out to be? 1080 and 720. Based on the output, when we apply the standard input output ratio, and what we get is going to be RSQ, total actual input into standard proportion of each material. It holds total quantity constant while forcing the standard ratio. Okay. Okay. Material cost variance, standard for actual output minus actual. When we break it down, we get material price variance and material usage variance. Why? MCV equals to MPV plus MUV, material price variance plus material usage variance. This again splits into mix and yield. We look at the bottom. I don't like the color, but yellow. Okay, right. Material price variance on purchased or on used. So understand something. Quantity purchased is going to be different from quantity used. You have purchased more, but you have used less. There could be a difference. This is where the exam trap is. Which quantity to use and when to use the different formulas. So purchase quantity, when the question gives both purchased and used, if he is asking for, if he is given purchased as X but used as Y, then you always use purchased. Or if he asks material price variance without quantifying it, use used quantity when the question specifically says material used or only purchased equals to used. I mean, ideally in this scenario, using purchased or used is still the same. But unless the question specifically mentions using material variance, used material should only be used when he asks for it. When both of them are given, don't ever get confused and go for used. Only go for purchase. Though the answer might be correct, but institute's preference is also something we should look into, keep it in our mind. Okay, material usage variance. Standard quantity for actual output minus actual quantity. Here, price variance, we're talking about price, standard minus actual. Usage variance, we are talking about usage that is for actual output. We are not taking for 400, we are actually taking for 360, right? We already calculated the standard quantity for actual output 360 minus actual quantity used. In this case, it should have probably been around 1080 and 720, but I think we saw around 1100 and probably 800 or something like that. The difference is there, right? What is the standard quantity for actual output and the actual out, I mean actual quantity used into standard price. Here, actual quantity purchased or used. Okay, both of them are received 1000 minus, okay, that's there. 1080 minus 110 into 40 for alpha, for beta 720, okay, 720 minus 750 into 60 for beta. So for alpha we got adverse, that is 800 of minus 800, and for beta it's also adverse of 1800. Net off together per unit we got an adverse of 2600. I'm not dwelling into the numerical part because calculations can be done by you. Okay, it's been 25 minutes, but we're still not done. That's all right. Okay, material mix variance. Revised standard quantity minus actual quantity. Revised standard quantity for alpha is 1008, I mean 1850 into 3 by 5, that is 1100 kgs. Did we not already calculate this? RSQ for beta is 1080 into 250, I mean 2 by 50, 2 by 5, that is 740. Okay, wait. RSQ we didn't calculate. This is not RSQ. Right. So once RSQ is calculated, we input that data into formula. 1080 into 3 by 5, 1080 into 2 by 5. So what is RSQ? Why are we splitting it? Understand something. Once the revised standard quantity is only, you know, deviating from the actual quantity used, will we understand what is the mix difference? I know that alpha and beta are supposed to go in 3:2 ratio. But I should also understand, did they go in 3:2 ratio? No, sir. But for actual output, do I know the standard quantity used in the standard ratio? Did I use it or not? We probably are not aware. That is the reason why we separately calculate RSQ, change, I mean, see the difference with the actual quantity used, multiply it with standard price to get material mix variance. Alpha, we notice that we got 400 plus. Why? There is a 10 difference. And for beta, we have 600 adverse. That means beta we have adversely used, alpha we have used in a favorable mix. Based for the actual output received, we have considerably used it in a good sense. Material yield variance. Yield variance is always based on output. Remember, when we are talking about the biryani example, mix variance is when the items are going in the ratio they are supposed to. Yield variance is always talking about the output. Isn't this not the output we were talking about? 10 plates to 10 plates or 10 plates to 9 plates. This is the output part. So when it is the output part, the formula is going to be standard quantity for actual output minus RSQ. Sir, understand something. What did I tell you? Material usage variance is when you add both of these. Standard price being common. Standard price being common. What is material mix variance? Devised standard quantity minus actual quantity. What is material yield variance? Standard quantity minus RSQ. RSQ cancel. Standard quantity minus actual quantity into standard price. Is that what we are talking about? for usage variance. Did we not get that when we add these two? That's the reason why material usage variance is equals to material mix variance plus material yield variance. Right. Even if the mix is right, did the inputs convert into the expected output is a question. That is why a process, a process efficiency problem, because we see alpha is at adverse of 1200 and beta is also adverse of 1200. So net off we are adverse of 2400 for material yield variance. Let us mathematically compare. So material mix variance is 2000 adverse. Material yield variance is 2400 adverse. When we add the total, 2600 adverse should be material usage variance. See, right. MCV equals to price used. Okay, you can ignore it. Standard table, not something I look at. Okay, labor variances. Let's try to, increase the pace. I already explained the logic. Hours paid equals to not hours worked. 9 equals to 7.5 plus 1.5 is the example I give. I gave 9 hours is my time in office. 7.5 times might be the hours I work. 1.5 times might be the idle hours. Workers are paid for all hours in the timesheet, including idle hours, machine breakdown, waiting for material, so on and so forth. This is in specific of labor. Hence, we're talking in terms of manufacturing reasons. Efficiency can you only judge by the work, number of hours they actually worked. So, actual hours paid equals to actual hours work plus idle time. This is the crux. We already got to it. Okay. Rate variance uses paid hours. Efficiency uses hours worked. And idle time variance obviously uses idle hours. Right. Rate variance applies to every hour on the timesheet. Is the rate, being justified? Efficiency variance, can we judge them on total number of hours? No. Can we judge them on idle time? No. We can only judge them on the actual hours work. That's the reason why efficiency variance always uses actual hours worked. Cannot judge efficiency during idle time, obviously. Cannot judge it on the total time as well because idle time is part of it. Idle time variance obviously is always going to be adverse unless we get a zero. Always extract actual hours worked first. Actual hours worked, we already know the formula. Right. Cost variance. Standard cost of actual output minus actual cost. Again, cost variance equals to, okay, sorry. Labor rate variance equals to standard rate into actual hours paid. We're talking about rate. So total hours paid. When it is idle time into standard rate, it is always going to be, adverse. If the employee is not working, would it ever be favorable for the company? No. So any cost that is going because of it, it's always going to be an adverse that the company has to be bearing. Idle time is a complete loss. The worker is paid for producing nothing, but there is no such thing as a beneficial idle hour. Just by him sitting and not running the plant, we are not going to get anything out of it. So there is not going to be any. So grade 1 and grade 2 calculations are done. Then labor efficiency variance. Standard hours for actual output minus actual hours worked. We already spoke about it. Efficiency can be only judged on the number of hours worked into standard rate. You calculate both of them. Labor mix variance, revised standard hours. Okay, sir, what is revised standard hours? Similar to RSQ, total actual hours worked into standard proportion for each grade. Ideally, total hours they worked great. But what is the proportion for each grade is what they should also understand. Because it has to be split. The total number of hours worked is what we'll have. So RSH for grade 1, 4 by 10th, and RSH for grade 2 is going to be 6 by 10th. Total hours worked is given. Then grade 1 and grade 2. Labor yield variance. So when we're talking about yield, it is always based on output. We already spoke about it. Yield is always for the output. Actual output minus standard output from actual hours worked. See, whenever you're calculating yield, should we include idle time? No, right? Idle time, they're doing nothing. That means when they're doing nothing, those specific hours is providing or producing output of zero. That is the reason why when you're calculating yield variance, kindly don't add the total hours paid, only use the actual hours worked. So actual output minus standard output from actual hours worked into standard labor cost per unit. Standard output from actual hours, all actual hours worked divided by standard hours per unit. You get it? Again, labor cost variance is gonna be rate plus idle time plus efficiency. And efficiency is again mix of, efficiency is kind of like the usage variance, right? Mix plus yield. Again, let's ignore the table. Now all we have is variable overheads and fixed overheads, and we are good to go. Okay, variable overheads. Sir, understand something. Variable overheads based on number of hours worked or the number of units, it changes, right? As it is variable. When variable increases with every labor hour worked, budget for variable overhead equals to rate of variable overhead into the hours. Only two things can go wrong. One, rate, two, the hours. Similar to sales, when we are talking about sales price or the quantity being changes, these are the reasons for variances that we can see. Similarly, for variable overheads, only two factors, rate and hours. Most common confusion, budgeted or variable overheads for actual hours is equals to variable overhead rate into actual hours worked, not standard hours, not budgeted hours. This step trips almost everyone in this exam. This is the reason why I've highlighted it again. Sir, understand once again. Very important. Budgeted variable overhead for actual hours. When we're talking about actual hours, would it be standard or budgeted? We always get confused looking at the budget. The word budget confuses us. It is derailing us towards standard or budgeted. But no, we are talking about budgeted variable overheads. We are taking the budgeted variable overhead rate. We're already taking the rate in place. Since you're talking about actual hours, variable overhead, it's gonna be dependent on the hours which are applicable for output. What are the hours which are applicable for output? Hours worked, not idle time or the actual hours paid. You're only looking at hours worked, hence the actual hours worked. Understand this, you'll never go wrong. Okay. Variable overhead cost variance, variable overhead expenditure variance, efficiency variance. Okay. Standard variable overhead for actual output minus actual variable overhead. As always, the first cost variance is one thing you can easily, solve in any MCQ if you get one. It's always going to be standard minus actual. Okay. Variable expenditure variance. Sir, we're talking about expenditure being varied. What is the expenditure that should have been budgeted? Variable overheads for actual hours, hence budgeted, variable overhead rate into actual hours worked minus actual hours. I am gonna compare, is it standard for actual output? No, we're not looking at output, we're looking at number of hours worked. Another thing, are we looking at standard? We're looking at budgeted variable overhead rate, but the actual hours worked minus the actual variable whole itself. Variable efficiency variance. So we're talking about efficiency. Efficiency is always, again, when I'm efficient, I see results. Results in terms of manufacturing entity are going to be, for a production line, always going to be output. So variable overhead efficiency variance is going to be standard variable overhead for actual output. You see this? Minus budgeted rate. Even if you remember these two, to remember the third one, it's pretty easy because we already know variable cost, variable overhead cost variance is going to be variable overhead expenditure variance plus variable overhead efficiency variance. When we look at this, when we look at this and this are going to be cut. So standard variable overhead for the actual output minus actual variable overhead is what we will get. See, it's pretty easy. As long as you're breaking down the formula or what is the cost variance, efficiency variance, expenditure variance, you can then link up between the formulas and you're eventually gonna understand as to what it is. You might wanna see the entire standard costing once or twice so that it is gonna be beneficial, but that is how I would want you guys to go ahead with this. Right. We have 7 viewers. That's cool. Okay. Again, not dwelling into the figures part, but ideally you should see the same. Okay, see, we know the cost variance has come to 1000 adverse. You got 2000 adverse and 1000 favorable. Net is again going to be 1000 adverse. See, it is always going to match. If it's not matching, probably you've gone somewhere wrong while calculating, doing multiplication. So please be wary whenever you're solving a standard costing sum, especially if you're attempting the 10 or the 14 marks one. Ensure your variances balance out each other. The totals ideally will come to the same, right? Since you know the relation between them, use that to your advantage and verify your numericals then and there itself for any arithmetical mistakes. All right. Now let us look at fixed overhead variance. Fixed overhead variance does not change with output. Obviously, it is fixed. Rent, salaries, insurance, 38,000 if you pay, for instance. Even if you produce 100 goods or 1000 goods, rent is still going to be the same, right? But you absorb or recover fixed overheads through production. That is where we talk about production, sorry, variable, overhead absorption rates, under absorption, over absorption. The concept comes over there. Absorbed fixed overheads equals to actual output into standard hours per unit into fixed overhead rate. Fixed overhead rate is going to be there, right? On what is it going to be applicable? On the actual output against the standard hours per unit. That is the absorbed overhead rate. If you produce less than budgeted, you absorb less. Of course, the number of units are going down. You cannot absorb more if the actual output is less. Unrecorded fixed cost sits as unabsorbed or underabsorbed. Okay, this is okay. Fixed overhead rate. You already know this. Budgeted fixed overheads by budgeted number of hours. We're just calculating a basic rate. Revised budgeted hours. Okay, this was only gonna be applicable when the actual number of working hours and the budgeted number of working hours are gonna be different. That is where we see the four variance only, the four variance analysis. That is where it comes into picture. If you look at this question that we're solving, working days based on budget is around 25, but actual working days is 24. That is where we'll see a deviation. Let's look at it. So when I'm talking about actual working days being 24, but my budgeted days being 25, don't you think the number of budgeted hours, what are the budgeted hours given? 4,000 budgeted hours are given, right? For how many days? 25 days. But how many are my actual? When I'm talking about budget, based on the actual working days, how much should the budget be? Okay, pen is not working. How much should the budget be? It's obviously going to be around 24 by 25 into 4,000. That is going to be 3,480. 3,000, sorry, 840 for 24 hours. These are the actual number of working days. This is the budgeted number of days. These are the budgeted hours. based on the actual number of days, I should also get budgeted number of hours for actual number of days. That is revised budgeted hours. As simple as it is. You just take a proportion out of it and you get it. Actual working days by budgeted working days into budgeted hours. We use only 4 variance analysis when actual working days not equals to budgeted. This adds the calendar variance. Right. Let's look at all. Absorbed fixed overhead minus actual fixed overhead. It's pretty common, basic. It's kind of like the standard. Expenditure variance. Sir, I am trying to understand. I've already budgeted for something, but the action is different. Similar, for instance, I've already thought the rice is going to be of 50 rupees, but the actual is was 52 rupees. So budget, which I thought, which I was set up in place was 50, but the actual was around 52. Similarly, budgeted, whenever we're talking about the expenditure, budgeted fixed overhead less actual fixed overhead. We already have the totals. This is already 380 given, and actual fixed overhead is also given in the question. I remember it. See, fixed overheads total is given, actual fixed overheads is also given. There we go. Sir, when we talked about absorbed, 342, if you notice, we already calculated it before. 342. Sir, how did I calculate this, sir? I know that for my variable overheads, 950 is what I have per unit. 950 is what I have, budgeted is 400, but the actual produced is around only 360. So 360 into 950 gives me 3,42,000. This is the absorbed part, because on based on the output and the rate, we already know actual output into the rate, we get the absorbed fixed overhead. What is left is the variance we should look at. Now, let us look at volume. Whenever we are talking about volume, to what extent is it absorbed? Against what is the budgeted? That means we know why does absorption have a issue? Here we spoke about it. If produced less than budgeted, you absorb less. This sentence itself is clearly talking about volume. If produced less, what did I produce out of 400, which I thought should have been the case, right? I only produced 360. For 360, what did I understand? 3,42,000 is the, sorry, 3,42,000 is the absorbed, but for 400, my budget was already 3,80,000, no? That means the volume difference, which is bringing in the variance, is my volume variance. Absorbed versus budgeted. We get it adverse. Makes sense? Right. We also know only when we have the difference in actual working days and budgeted working days do we see a calendar variance. Correct. So fixed overhead calendar variance. Since we already know it's going to be calendar variance, can we just take budgeted hours? No. Sorry, can we take actual hours? No. We have to take revised budgeted hours. Revised budgeted hours minus budgeted hours. Ideally, it should have been 4,000, but we only got 3,840, something like that. Yes. 3,840 for 24 days. For 24 days, we got 3,840, and for 25 days, we got 4,000. So, because of the calendar difference of 1 day not being utilized, that is the deviation on the budget, what am I seeing in difference of fixed overhead as a variance is fixed overhead calendar variance. So, revised budgeted hours 3,840 minus actual budgeted hours 4,000. So I am seeing a net of 60 hours being negative, but I should also get it in amounts. So multiply by 95. That is the fixed overhead rate. 15, 1200. Sorry, 15,200, right? Now what do we have? Fixed overhead capacity variance. Fixed overhead capacity variance. Capacity again, we're talking about the cap. What is the maximum they can do? Actual hours worked is what they've done versus the budgeted hours as per the actual output is what they can do. That is what we'll see. Capacity. They've only produced, I mean, they've only worked for 3,550 hours, where they could have actually, been productive for 3,840 hours. That is the capacity variance. There, it is more like a utilization. To what capacity did they perform? Efficiency variance. We always spoke about efficiency variance being in terms of actual hours worked is where we see efficiency. It is not actual hours paid. It is never going to be that because this includes actual hours worked plus idle time. We don't want to consider idle time because idle time has no efficiency. There is no output generated. Only actual hours worked is what we have to consider. You have to understand why we are taking actual hours worked. If not in the exam, you're again going to be confused. We have to, should we take actual hours paid or actual hours worked? So absorbed overhead minus actual hours worked into fixed overhead rate. 3,42,000 is absorbed for 360 units. We already found out it's the same. Actual hours worked is 3,550. The rate is 95. You see a favorable variance. With that, we are done with the sum. Let's see. These points you guys can go through. Cross check your reconciliation against actual revenue. Please do it. If actual costs are all given, including sales and sales price, kindly do check this. Ideally, if sales price and sales variances are not asked, only is the case when you probably cannot do this. If it doesn't, one of your subvariants has an arithmetical error. And to identify these and not step into that, under the head of variance, that is material, labor, variable overheads or fixed overheads or sales variance, you already know the sublinkage. So you can cross verify based on that, as the overall totals don't just start again multiplying and subtracting all the numbers. First do the preliminary verification between the subheading. If you found out a discrepancy, then you dwell into the actual calculations for individual variance that you've done, right? So I think with this problem, it should be good to go. Anything else we should look into? So reconciliation statement, uh, sales volume at variance you've reduced, then standard profit on actual sales. Okay, then you derive to actual profit, right? Makes sense. So all this material, you guys have it in the link where you have to submit a Google form. Upon submission, you get the final page, right? In that, you will have multiple links, out of which the first link is going to be the drive link, to which the two other master problem material PDFs, along with the initial strategy uh, PDF and the standard costing master sum PDF are going to be available, right? So with that, I think we can take a leave. I hope you guys had fun. All the very best for your exam. Do let me know in the comments as to how it went. Uh, Let me know if you also need any other additional resources. I might try to provide them. So